When you step into the world of finance, you will encounter many different terms and strategies. One of the big questions that every investor has to face is, should I be a holder or a trader? This decision can directly affect your investment strategy and even the final outcome. Have you ever wondered whether you are the type of person who patiently waits for the right moment in silence, or the one who enjoys surfing the waves, buying and selling continuously to make quick profits? The difference between a holder and a trader does not only lie in their trading methods, but also reflects a different investment philosophy. Let's explore this difference in detail and analyze which strategy might suit you better. Welcome to Day Trader, where we expose the raw truth behind the waves of the financial market. Here, we don't just talk about profits and losses, we dissect the psychology, mindset, and mental toughness of a real trader. Part 1. Holder. Calm but persistent. Holder is a long-term strategy, an investment approach that is neither rushed nor swayed by short-term market fluctuations. Those who choose this method are not seeking immediate profits. Instead, they focus on the long-term potential of the assets they hold and place their trust in their sustainable growth. They are not afraid of volatility and always remain confident in the strategy they have chosen. When you are a holder, every decision you make is carefully considered. You are not pressured by market swings. Instead, you patiently observe and wait for opportunities. In the financial world, this patience is one of the most crucial factors for success. People who choose the holder strategy understand that they are on a long journey, not a short race. They are like a gardener, planting a seed, nurturing it daily, and waiting for the day of harvest. Imagine you are that gardener. You don't expect your tree to grow overnight. Instead, you understand that for it to blossom and bear fruit, it needs time, patience, and meticulous care. Sometimes, strong winds blow, heavy rains come, and the tree sways. But you don't rush. You know that as long as you continue to care for it properly, it will eventually grow and bear sweet fruit. That's exactly how a holder views the market. They understand that, although the market can fluctuate sharply at times, the true value of an asset will reveal itself over time. They don't panic sell stocks or coins when prices drop in the short term, because they know the assets they hold have intrinsic value and will grow in the future. A prime example of a successful holder is Warren Buffett, one of the greatest investors of all time. Buffett is famous for his long-term, patient investment strategy. He always looks for companies with strong foundations and sustainable growth potential. Buffett never gets caught up in short-term market turbulence. He has bought shares of major companies like Coca-Cola, American Express, and Berkshire Hathaway, holding them for many years. Throughout his investing journey, Buffett has not only earned massive profits, but also proven that patience in long-term investing can lead to extraordinary results. For holders, patience is the key. They don't worry about short-term volatility and stay focused on the fundamentals of the assets they own. For instance, when you buy shares of a major tech company like Apple or Microsoft, you're not just looking at today's stock price, you're looking at the company's long-term growth. You believe that with a solid foundation, these companies will continue to thrive and deliver profits in the future. Like a diligent gardener, a holder must have a long-term vision. They understand that results won't always come immediately, but they believe that with patience and consistent effort, the rewards will eventually come. This belief in the long-term potential of their assets is what sets holders apart from short-term investors. That's why holders never rush. They believe patience will bring worthy rewards. For those who choose the holder strategy, it's not a game of haste. It's a long-term journey built on endurance. And they know that smart investment decisions and persistence will lead them to achieve their financial goals in the future. Part 2. Trader. Dynamic and ever-changing in-laws. In contrast to holders, those who follow the trader strategy have a completely different style. They are dynamic investors, constantly seeking immediate opportunities. While holders may sit still and wait, traders are always moving, constantly observing and exploiting market volatility. Instead of focusing on long-term potential, traders care about short-term changes, the waves they can ride to make a profit. For traders, every day feels like a never-ending adventure. They look for opportunities even in the smallest market movements. A price surge or a sharp drop Both can be chances to enter a trade and earn profit. This is not a strategy for the impatient, as every buy and sell decision happens quickly, sometimes within minutes, hours, or days. Capturing these short-term opportunities requires a sharp analytical mind and a keen sense of the market. Traders use technical analysis tools to identify entry and exit points. They study charts, technical indicators, and price patterns to make decisions. The key for a trader is the ability to read the market, understand its trends, and act before opportunities slip away. For example, if a stock or cryptocurrency shows signs of a breakout, breaking through a key price level and potentially surging, a trader will enter immediately. If the market reverses, they will exit just as fast to protect profits or limit losses. For traders, time is money, and every second can mean either an opportunity or a loss. For traders, it's not always about whether a company is performing well or not. They don't focus much on fundamentals like cash flow, earnings, or long-term outlook. Instead, they center on one question: can the value of this asset change in the short term? They observe the market, analyze investor behavior, and make decisions based on the signals the market provides. Imagine traders as race car drivers, always focused on the track, ready to accelerate the moment an opening appears. Every minute, every second is precious for speeding up and overtaking competitors. They don't hesitate to overtake when the chance comes, and they don't fear risk. Because in the world of trading, every acceleration can bring a big reward. However, like real racers, traders must stay calm and focused, never losing concentration. One wrong move or hasty decision can cost them everything. Traders also need to know when to stop. The market doesn't always offer opportunities, and sometimes waiting patiently is the best move. But when a chance arises, traders seize it without hesitation. For instance, day traders, those who trade within a single day, never hold positions overnight. They execute buy and sell transactions during the day, taking advantage of small fluctuations to create quick profits. If a stock shows strong intraday volatility, they buy when it rises and sell when it pulls back, capturing fast returns. A famous example of a successful trader is George Soros, who earned billions of dollars from his attacks on currencies and financial markets. One of his greatest achievements was breaking the British pound in 1992, causing it to plunge in value. Soros didn't rely solely on fundamentals. He used technical analysis, tracked trends, and struck when short-term opportunities appeared. This strategy brought him billions in profit and proved the power of a trader who can seize the market at the right moment. Traders, therefore, live in volatility. They constantly seek opportunities within the market's movements. They pay little attention to macro factors, focusing instead on analyzing small price changes to generate profit. Like racers, they rarely stop moving. Every second is a chance to accelerate or hit the brakes. Alertness, sharp intuition, and quick decision-making are the keys to their success. Part 3. Comparison between holder and trader. When we talk about holders and traders, there's a clear difference in their approaches and investment strategies. Holders, long-term investors, are patient individuals who always look ahead, aiming for stable and sustainable profits in the future. Meanwhile, traders thrive in market volatility, constantly adapting and seizing short-term opportunities. Despite their contrasting methods, both share the same ultimate goal: to make a profit. The difference lies in their approach and perspective. 1. Holding period. The first major difference between a holder and a trader is the length of time they keep their assets. Holders are patient investors who have no intention of selling their assets in the short term. For them, investing is a long journey, sometimes lasting years or even decades. They buy assets with confidence in their long-term value. For example, a holder might buy shares of major companies like Coca-Cola or Apple and keep them for decades, believing these businesses will continue to grow and deliver sustainable profits over time. In contrast, traders typically hold assets for a very short period, sometimes just hours, days, or even minutes. They seek to profit from small market fluctuations. Traders frequently enter and exit trades within short intervals, relying on price movements and technical signals. For instance, a trader might buy a stock in the morning and sell it in the afternoon if the price surges, aiming for quick, short-term profits. 2. Market volatility. Another key difference lies in how they handle market volatility. Traders embrace market swings. They see volatility as opportunity. They understand that the market rises and falls rapidly, and these movements create chances for profit. A breakout signal, a correction, or a sharp price jump, all of these can become trading opportunities. Traders don't fear change, they rely on it. Holders, on the other hand, are largely unfazed by short-term volatility. They don't pay much attention to daily price changes. Instead, they focus on the long-term value of their assets and believe the market will self-correct over time. A holder might not worry if their stock drops 10% in a week because they trust that it will recover and grow in the long run. A prime example is Warren Buffett, who held Coca-Cola stock for over 40 years despite significant fluctuations during that time. 3. Risk level. Risk tolerance is another major distinction between the two. Traders, with their short-term approach, tend to accept higher risks in exchange for quick profits. They don't hesitate to enter trades at high or low prices within the same day, knowing that opportunities come and go quickly. Traders often use risk management tools like stop loss or trailing stop orders to minimize losses when the market moves against them. Though risky, skilled traders can generate substantial profits by mastering these rapid fluctuations. Holders, however, generally adopt a lower risk strategy. They invest based on long-term potential and are less affected by short-term market noise. For them, the real risk lies in choosing assets without strong long-term growth or investing in weak companies. That's why holders conduct thorough research before investing and rarely panic sell during downturns. In summary, traders take on higher risks to capture short-term opportunities, while holders aim to minimize risk by focusing on solid, long-term investments. Traders' willingness to embrace risk can bring fast profits, but also large losses if mismanaged. Holders, meanwhile, rely on patience and market stability to earn greater rewards over time. Whether you choose to be a holder or a trader, each strategy has its strengths and weaknesses. The decision depends on your personality, risk tolerance, and financial goals. Both can be profitable paths. What matters most is understanding your chosen approach and staying consistent to achieve the best results. Part 4. Which strategy suits you best? So which strategy should you choose? The choice between being a holder and a trader isn't always as simple as saying one is better than the other. Each strategy comes with its own benefits and challenges, and most importantly, your choice depends on your personality, financial goals, and how you see the market. There's no perfect strategy for everyone, and understanding which type of investor you are is an important step towards success. 1. If you are patient and believe in the long-term future, holder might be the right choice. If you tend to be patient, focus on long-term opportunities, and aren't easily swayed by short-term market fluctuations, then the holder strategy might be the one for you. Holders view investing as a long journey, where profits come from the steady growth of assets over time. You won't rush to sell when the market fluctuates. Instead, you'll look for assets with strong foundations, like blue-chip stocks, real estate, or even cryptocurrencies with long-term potential. The holder strategy requires patience and confidence in the market's recovery after downturns. If you can endure declines without panicking and believe in your asset choices, holding will fit you well. Warren Buffett is a perfect example of this approach. He has held stocks for decades, ignoring short-term price swings and focusing on the long-term value of the companies he invests in. However, being a holder has its challenges. The market doesn't always move the way you expect, and there will be times when profits don't come quickly. If you choose this path, patience and faith in your investments are key. You must also accept that immediate returns aren't always possible. 2. If you are dynamic, love excitement, and seek short-term opportunities, trader might be your path. If you're energetic, love change, and feel thrilled by the fast pace of the market, trading might be the right fit for you. Traders thrive in volatility. They're risk takers who look for short-term opportunities to profit. If you get excited by price movements happening within minutes, hours, or days, and can analyze and decide quickly, then trading could be your thing. Traders love the rush of the market. They enjoy spotting opportunities and acting fast. One of their strengths lies in analyzing charts and using technical tools to find entry and exit points. If you enjoy working with indicators and making fast decisions, trading can be an excellent match. But trading also brings more stress and risk. The market can shift suddenly, and without solid risk management, losses can come fast. Traders must constantly analyze and learn, since markets evolve and no strategy works forever. A great example of a successful trader is George Soros, who earned billions through sharp, fast decisions. He's famous for breaking the Bank of England in 1992, when he correctly predicted that the British pound would fall and made $1 billion in a single day. 3. Understand your personality and financial goals. In the end, choosing between being a holder and a trader depends on who you are and what you want. If you prefer stability, are comfortable with long-term investing, and can handle market ups and downs calmly, then holding is right for you. If you love action, crave excitement, and want to seize short-term chances, then trading is your lane. Ask yourself, what are my financial goals? How long am I willing to wait for profit? If you're after stability and can commit to long-term investing, become a holder. If you want fast returns and can handle risks, trading might suit you better. There's no best or worst strategy. The key is understanding yourself and picking what aligns with your goals, personality, and risk tolerance. Both holders and traders can succeed. The difference lies in how and how fast they achieve profits. If you enjoy studying markets and short-term moves, go for trading. If you value patience and steady growth, holding is your way forward. You probably have a clearer understanding now of the difference between a holder and a trader, right? No matter which path you choose, the most important thing is to understand your strategy and stay consistent with your decisions. If you found today's discussion helpful, don't forget to hit the subscribe button and share it with your friends who are also interested in the world of finance. Thanks for listening, and I hope to see you again in the next video.